Good afternoon if you're tuning in from the Gulf. It's a pleasure to be with yourselves. Thank you for those of you who are attending our today's webinar on perhaps a bit more of a niche topic, but a topic that we know very well. I'm joined today by my colleague Nishi Agarwal, who's a counsel in our firm. And today we're going to be taking you through taxes for investment funds, specifically the UAE tax considerations for investment funds set up in the UAE, as well as potential considerations associated with investment funds. We're going to be taking you through a number of topics. At the end of the session, we will leave some Q&A as well. We're going to be trying to end around the hour mark, so around 2:30. And then we will take your questions at the end. Of course, if you do have any further or additional questions, feel free to mail those in. In the meantime, if you think of anything, please feel free to drop it in the Q&A box or in the chat box as much as possible. And to the extent that time permits, we will be addressing those questions at the end. So it's a pleasure to be with yourselves. What we're going to be looking at today is I'm going to give a number of introductory remarks in regards to the landscape of investment funds. Nishi and I will subsequently take you through a number of things. Number one is the tax regime and how it is different between mainland and free zone. What is the tax regime applicable to the various stakeholders which may be involved in the managing of a fund? The complications around the application of funds and their operations abroad, so transactions which go cross borders, notably what kind of treaty issues exist there, what kind of potential tax credit issues exist. I'm going to take you then through another key consideration around PEs for foreign investment funds, to then go through the fund stuff, compliance obligations, and also in the end, as most of you would be aware, there was a recent change to the VAT Executive Regulations in the UAE, which is going to enter into force as from the 15th of November, and those changes also have an impact on investment funds. So we will also dedicate some time to go through these as well. Setting the scene perhaps a little bit, not necessarily immediately tax related, but as we can see from the different press releases from ADGM, DIFC, but also ESCA, there's a substantial increase in the assets under management in the UAE. So you might have seen as well, there was a press release last week as well, stating that Abu Dhabi is now the capital in the world with the most assets under management. So you can see that it's a sector which has known substantial growth in recent years. We've seen notably as well a move from, for example, funds in Hong Kong and Singapore to relocate here, to have a second base here, or for fund managers to relocate to the UAE. You see in mainland, ESCA said in August 2024 that there was an increase of 35 billion dirhams in assets under management. The DFSA saw a 25% growth rate in fund and asset managers licensed in the DIFC in 2023. And you see that there's significant foreign direct investment inflows as well in 2023 as opposed to 2022. Now, mainly we will be discussing ADGM and DIFC because there's simply more to state there. But probably good to remind yourself when we're going to be covering the tax regime in more detail later on, is that the legal regime applicable to the fund has an impact on how it is treated for tax purposes. So whether the fund is structured as a company or a trust or a limited partnership, that has an impact on how the fund is viewed, how the fund is analyzed from a tax point of view. So it's important to keep that in mind while we go through the rest of the analysis. Now, obviously, for most of you, I hope that this slide would be familiar to you in the sense, or at least the contents of this slide, in the sense that most of you would be by now somewhat familiar with the corporate tax framework in the UAE, but perhaps just still by way of introduction, setting the scene a bit. All right, the corporate income tax law, which is applicable, effectively applies in terms of the tax liability on or after 1st of June 2023, with a default rate of 9% and a 0% rate up to 375,000 dirhams of profits, with a, very importantly, 0% withholding tax for payments made to non-resident persons. In addition to that, a free zone regime, which we will be discussing more later on, which allows qualifying free zone persons to earn 0% on qualifying income, while 9% is applicable on non-qualifying income, with a couple of important characteristics important for the financial services and fund sector. One is that there is a so-called QIF exemption, so qualifying investment fund exemption, which we will talk about a bit later, an investment manager exemption, which Nishi will be talking about later as well, and a important participation exemption as well, which I will be covering in a bit more length later on. So we're going to try and hand over to my colleague now while trying to mute myself. If you give me 1 second. Yep. The floor is yours.
Hi, good afternoon, everyone. Thank you for joining us today. Thank you, Thomas, for introducing the topic to the participants. I would be talking about the free zone regime that is applicable to entities that are established in the free zones. As Thomas mentioned, that there has been an increase in the number of licenses that are issued by the regulatory authorities in DIFC and ADGM. It is important to evaluate whether free zone entities that are established in the free zones could potentially benefit from a 0% tax rate. Now, just by being established in a free zone does not entitle a person to benefit. There are certain conditions that are attached to it, and I would be speaking on the conditions. So there are 6 to 7 conditions that are required to be met by a free zone person. The first being that an adequate substance should be met. What this means is that the core income generating activity pertaining to the business of the free zone person should be performed from within the free zone. So while evaluating the adequate substance, it is important to look at the employees, the operating expenditure, as well as the assets that are utilized for deriving income. Then looking at the next aspect, that is deriving qualifying income. If you see here, it specifies that the income should be in the nature of qualifying. So it's not just deriving income, but if it meets the condition of qualifying income, only then can it be considered as meeting the condition. The free zone person does not have to elect specifically to be taxed at 9%. It needs to meet the transfer pricing regulation. Now, this is applicable irrespective of whether an entity is a free zone or not. So this is just an additional condition that has been included here. In addition to this, there is a de minimis threshold that has been prescribed, which allows a free zone person to earn non-qualifying income up to 5 million dirhams or 5% of the revenue threshold, whichever is higher. Sorry, whichever is lower. In addition to this, the free zone person is required to maintain audited financial statements. Now, in the CIT law, there is a limit beyond which an entity is required to maintain audited financial statement. However, for a QFCP, the audited financial statement should be maintained irrespective of the revenue threshold. and any other conditions that might be determined by the minister. Now, there are no other, for the time being, no other conditions have been prescribed, but only these conditions should be met. If in any tax period, a free zone person fails to meet any of the conditions, then in that case, the person will be subject to tax at 9% in that year and subsequent 4 tax periods. So it's a domino effect that comes into play. While talking about the qualifying income, when a free zone person interacts with another free zone person, it is important to evaluate whether the income is derived from an excluded activity. If not, all the incomes that is derived from a free zone person will be treated as qualifying income. However, the person to whom the services or goods that are being rendered should be the beneficial owner of such services and goods. However, it's not always possible for a free zone person to interact or transact with another free zone person. So the ministerial decision outlines a list of qualifying activities that a free zone person needs to perform if it's transacting with a non-free zone person. So while evaluating whether an income derived from qualifying activities falls in the list or not, you need to make sure that the activity is falling a part of the qualifying activity. And at the same time, such an activity should not form a part of the excluded activity. Now, in the context of funds manager, we have seen that fund management services as well as the wealth advisory services form a part of the qualifying activity list. And hence, it is important to evaluate whether the functions performed by the fund managers could potentially fall under the qualifying activity and hence benefit from a 0% tax regime. That's it. Now, Thomas would be taking you through the tax implications of various stakeholders.
There you go. Sorry, there's always one or the other technical issue while I'm trying to find the unmute button, which doesn't always, my arrow doesn't show when I'm presenting full screen. Thank you very much, Nishi, for discussing the free zone entities. Now, just to put this in a bit more perspective from the viewpoint of what we call the participants or the stakeholders. So on the right-hand side, you see a simplified graph, really, of how an investment fund could be operating, making investments into different third-party companies, or sometimes using its own investee companies, which we will get to in a bit. With the investors coming in at the level of the investment fund, and the investment manager or the fund manager entering into a fund management agreement with the investment fund. Obviously, the graph is a simplification of what could happen in reality, because there's as many funds as there might be types of investments and sometimes investors. But for each part or each type of stakeholders, there are different elements at play. For example, if you're an investor, what would be very important is that you attempt to meet the conditions which Nishi just laid out, which would allow you to be a qualifying free zone person, and holding of shares or other securities is effectively a qualifying activity. So if you're an investor, chances are that the income that you will be receiving fall under qualifying income as the QFZP and are therefore subject to 0%. The other one, which would be important as well in the UAE context, is the participation exemption. And we will discuss this in a bit more length on the next slide. The same thing for the domestic dividend income, which is exempt without any condition, and personal investment income, which is not subject to our CIT law, which is widely scoped. And then for non-residents, obviously the 0% withholding tax on payments to non-residents is important. So those are a couple of the issues which are very important for the investors to consider in terms of the impact of the return on their investments. For the investment funds themselves, there's essentially speaking a number of possibilities there. We have a potential situation where the fund is simply structured as a company, or where the fund is considered as opaque when it is by default considered as transparent. I'll come back to those terms a bit later on, but essentially transparent means that the income flows through the entity rather than it being taxable at the entity level. In the situation where an investment fund is incorporated as a company, or where it is opaque, it can benefit from something called the qualifying investment fund exemption, which makes the fund itself exempt from corporate income tax. Where for whatever reason the fund is opaque due to the fact that it's set up as a company, or it has chosen to be opaque if it's a limited partnership, what would be important there? Well, the same issues would be important as the ones for the investors. Because if you're a non-exempt fund, but you're opaque, you're taxed as a normal corporate, which means if that normal corporate is in the free zone, you could be a qualifying free zone person. It also means the participation exemption might apply if you're in the free zone, but you don't qualify as a free zone person. And we again have the domestic dividend income exemption as well. If the fund were to be structured in such a way that it is transparent for tax purposes, something that we will get to in a bit, then the taxation of the fund is no longer at the fund level, but it moves up a level to the unit holders. Then have two more levels, which is the fund manager or investment manager and potentially their sub-managers, where they're, if they're mainland, 9%. If they're abroad, they're not in the scope of UAE corporate income tax in principle. And if they're in a free zone, then there is, as we will see, a qualifying activity for fund management. When it then comes to the investee companies or the potential SPVs, what we see there is that when it comes to qualifying investment funds, the entities which are wholly controlled by the investment fund, they could also benefit from that same tax exemption by extension if the qualifying investment fund benefits from it. So looking at this from the viewpoint of each level, perhaps starting off on the right-hand side, well, if I'm a natural person and I'm investing my personal investment income into a fund, or I'm investing in units in a real estate fund, and I'm receiving returns from that, that is not going to be subject to any corporate income tax, as we have a cabinet decision which states that for natural persons, any investment income or real estate income is excluded. The condition being that the natural person is not required to hold a license to derive that income. As long as the natural person stays within those bounds, it will not be subject to the corporate income tax law. For taxable persons in the UAE, as we already said, there's a couple of things which are at play. Number one is if you're an investor and you're a QFZP, then there's a qualifying activity of holding of shares and other securities, as long as the units are held for at least 12 months uninterruptedly. Then as a QFZP, you will be able to claim 0% applicable on the income which you earn from the fund. When it comes to dividend income, a UAE company to a UAE company, that dividend income will be exempt from corporate income tax in an unconditional way. When it comes to dividends received from foreign entities or capital gains earned from UAE entities or entities abroad, this is also exempt from corporate income tax, subject to discussions which are, conditions, which I'll be laying out in a bit. If you are a non-resident investor and you're earning income from units held in a UAE investment fund, then that income is subject to a 0% withholding tax. So there's no leakage there. The only attention point there would be if there's a non-resident legal person or a non-resident juridical investor which derives income from a real estate investment trust, then that income is taxable in the UAE. So how does the participation exemption apply? And as I said before, the participation exemption would apply for capital gains earned from UAE companies, from the sale of UAE companies, or dividends or capital gains earned in regards to a foreign participation. So what do the conditions say that need to be met in order to be exempting income? Number one is that you have a substantial shareholding defined as holding at least 5% or more, or an acquisition value of at least 4 million dirhams for the participation. Not just holding shares, but also being entitled to at least 5% of the distributable profits and liquidation proceeds. Also, again, here, a duration requirement. You cannot be a short-term trader. You need to have the intention to hold and effectively hold, in the case of capital gains, the shares for 12 months. In addition to that, the company in which you invest needs to be subject to at least tax at 9% corporate income tax or more, where at a domestic level, we already know QFZPs and exempt persons are considered to be meeting this condition. When it comes to a foreign jurisdiction, that should have at least a headline rate of 9%. And there's an additional relaxation, which is even if you don't meet the 9%, but the entity through which the shares of which you are holding itself invests in at least 50% of assets which would qualify if they were held directly, then the participation exemption would nonetheless apply. Moving to the qualifying activities. So this is important for what Nishi was saying before, which is I need to be conducting a qualifying activity when I am dealing with non-free zone persons, right? When I'm dealing with mainland customers or customers abroad, my activity needs to be on the qualifying activity list. When I have an activity free zone to free zone, the only requirement is that the activity is not on the excluded list. So there's two very important qualifying activities here. One is fund management services, defined in a reasonably broad manner. And the other one is wealth and investment management services, which is also described in a reasonably wide manner. However, the examples given in the free zone guide seem to be focusing a bit more on individuals. Both of those activities are subject to regulatory oversight of one or multiple UAE competent authorities, be that in free zone or mainland under ESCA. And the types of income which are derived from these activities, and then we're mainly looking at fund management services, performance fees, management fees, and co-investment income. Those seem to be suggested to be included here. As to qualifying investment fund, what we see there is that an entity which is a legal person or an entity which is considered opaque for tax purposes is eligible for an investment, is eligible for an exemption at the level of the investment fund. What are the requirements? Amongst others, that there's regulatory oversight for the investment fund or the investment fund managers, that the units or the interests are marketed, so they're made available to the public, that the principal purpose to set up the fund is not to avoid corporate income tax, that the main business of the fund is to carry out an investment activity, and that the day-to-day management of the fund is not with the investors, in addition to the fund manager having at least 3 investment professionals. We've answered many questions of clients as to the next condition, which is that there cannot be one single investor with related parties which holds more than 30% or 50% of the ownership, depending on whether there's less than 10 investors for the 30% or more than 10 investors. This essentially means that as a corporate, you cannot simply set up your own private investment fund, which would qualify for a fund exemption, right? For a fund exemption for tax purposes. This would not be possible from a regulatory point of view either. When it comes to real estate investment trusts, the same provision applies, but there's additional conditions, amongst others, in regards to the assets which are held. I have two more slides before I hand back over, or actually three, before I hand over back to my colleague Nishi. When it comes to investment funds, interestingly enough, the stance of the FTA is that we need to distinguish the types of income which are received from the funds. And the purpose of this is really to identify in the hands of the investors to see whether certain exemptions would apply. We've discussed previously the participation exemption. We need to be able to identify if I'm receiving income from an investment fund, whether a proportion of that could potentially benefit from the participation exemption. Separate from that as well, we need to identify what is interest income for the investor. This also has a good reason in regards to the interest deduction limitation at the level of the investor, in case there's leverage involved for the investment. Income from UAE movable property, because when it comes to investors investing into UAE movable property, when that's a foreign legal person, as we said a couple of minutes ago, that's subject to UAE corporate income tax. And equally so, even if it's a local investor, a local UAE legal entity, depending on where the real estate is located, that might also be subject to corporate income tax. And then finally, another category, which is stated or characterized as other income, right? So what happens through the QIF is that the income earned by the fund retains its character once it flows through to the investor. And the investor needs to report accordingly. In other words, it's not simply a dividend, it's not simply a capital gain when sold, but the fund has the very heavy task of actually having to go and identify, whenever it makes a distribution, what the split is in that distribution of the different types of income. Fiscally transparent structures are slightly complex. You see on the right-hand side that refers to two potential types: limited partnerships and investment trusts. The important thing here to take into account is when we go back to the introduction which we made reference to DIFC, ADGM, and how funds are structured there. The applicable laws and regulations in the place where the investment fund is set up are going to be determining also the tax regime applicable to it. If we're talking about a simple company, so a fund set up through a limited company, then that's simply a corporate which is in scope of corporate income tax, and therefore we need to analyze, as we said before, the QIF conditions, the QFZP conditions, and the participation exemption conditions. But when we're talking, for example, about an unincorporated partnership, and really, in our view, the only situation where that can happen is where you would have a limited partnership that doesn't have legal personality, which is a possibility under certain free zone regimes in the UAE. And what happens with transparency is that the income of the fund is attributable to the investors proportionate to their investments. In other words, the income flows through to the partners, to the investors in the investment fund. The transparent entity is the unincorporated partnerships. They can choose to become opaque. They can apply to the FTA to become opaque and to be treated as every other company. So it's really left up to the choice, probably of the fund manager or the sponsor of the fund, on the legal structure that you would like to adopt, and then associated with that, the ensuing tax regime applicable. What happens when an investment fund is fiscally transparent? Well, as we said, every partner, every investor is individually subject to tax. That may mean if it's a corporate, we need to look at QFZP or not, mainland or not. If it's an individual, he may not be subject to tax. If it's an unincorporated partnership, which is considered fiscally opaque, so that has applied to not be transparent, but on the contrary, be opaque, that opaque unincorporated partnership, UIP, can still apply to the FTA to claim exemption status, the QIF exemption, so the qualifying investment fund. What is important, however, is that the QFZP benefit is not available to an unincorporated partnership because they're only available to legal persons. As we said, tax needs to be assessed at the level of the investor, which means the investor can potentially benefit from the participation exemption or potentially other regimes applicable. As I said, could be a natural person, could be a QFZP, and whatnot. The income, therefore, distributed retains its character once it flows through, or once it goes up through a fiscally transparent structure. And also, finally, the income would be taxed in the hands of the investor in the year in which the income is derived by the investment fund. Now I'm going to try and hand back over to Nishi without any technical issues.
Thank you, Thomas, for outlining the domestic considerations with respect to investment funds. Although there's a lot of guidance that's given regarding the domestic tax treatments for QIFs and investors and fund managers, I would still say that there are certain complexities that are involved, especially when we talk about the bifurcation of income, and as well as the type of income that is being attributed to each nature of income. From a cross-border perspective, it is important to evaluate whether the investment fund, if it is considered as a qualifying investment fund, is entitled to treaty benefits while interacting with an investee company in the source state. Although a qualifying investment fund is treated as a separate legal entity and hence would be considered as a resident for double tax treaty purposes, the source state may deny the treaty benefits because it is not liable to tax. So we see that generally in treaties, residency is determined based on the liability to tax condition. Having said that, if the treaty has specifically included some form of investment funds within the definition of residence, then such investment funds should be eligible to apply the treaty benefits. Where the investment fund is able to apply the treaty benefits, then another point to note is if there's an investee company that distributes dividends to the investment fund, which is in the UAE in this case, then there could be a possibility of a higher withholding tax just because the investment fund is not considered to be a beneficial owner. So we see in a lot of double tax treaties, the concept of beneficial owner, and it's more of an anti-abuse rule to ensure that the owner of the dividend is in fact has a legal right to exploit the dividend received by it. Given that investment funds work more as a conduit, in a way that it's just managing the funds and any profits that are derived by the funds will ultimately be distributed to the investor, the source state may take a view that such an such an investment fund may not be considered to be the beneficial owner. However, it may also be argued that in case where the investment fund is widely held or is a growth fund for that matter, where there's no regular distributions happening to the investors, then such a fund should be entitled to the beneficial owner of a reduced withholding tax that is available to the beneficial owners. While a reduced withholding tax may apply or a higher withholding tax may apply at the source state, the investment fund, being an exempt entity, cannot avail the benefits of the foreign tax credit. When such dividends are being distributed by the investment funds, or where the funds are flowing from the investment fund to the investor, the question arises whether the investor himself can avail the benefit of the FTC, the foreign tax credit, or the withholding tax that has been levied in the source state. Usually, this may not be possible because there's an entity in between, and at the level of the investor, there is a possibility that such an investment fund is treated as fiscally opaque. So let me just explain you the example that's there on the slide. We see that in country B, the manner in which the investment fund is treated is fiscally opaque. UAE treats investment fund as fiscally opaque, as we have discussed before. And country A also treats the investment fund as fiscally opaque. So in this case, in a way, we can say, yes, UAE investment fund would be entitled to treaty benefits. However, if any of the countries have a different view of treating investment fund, that is, if it treats it as a transparent entity, then in that case, the treatment would differ. Now, as Thomas mentioned that in domestic consideration, the income that is derived by the investment fund will retain the character even at the level of the investor. Also, there is no timing difference in terms of taxation of investment income at the level of investor. That is, if in year 2024, an income is derived by the investment fund, then any income that is available for distribution will also be taxed at the level of the investor in proportion of its investment in the investment fund. However, in a cross-border situation, a problem may arise wherein there is a conflict of qualification in terms of income that is being distributed. So for example, let's say country B, while making any payments, it treats the payment as an interest income, right? So withholding tax will apply based on interest expense. However, UAE investment fund may treat it as dividend. So this could also lead to some differences. And as I mentioned earlier, the way in which the fund is being treated under each jurisdiction could also lead to the complexity. One more very important point that I would like to bring out here is if the UAE investment fund, under any assumption, assumes that a lower withholding tax may apply or the treaty benefit would be available and accordingly computes the net asset value of the fund itself, and going forward, the treaty benefits are not available, then that's going to have an impact on the fund value itself. So it's very important to achieve legal certainty at the outset. Now, looking at the global outlook, we see that Luxembourg, Singapore, and Hong Kong, all of them exempt funds. And this is in line with the principles that are also adopted by UAE. It gives UAE a competitive edge with these financial countries. In addition to this, we also see that no withholding tax are applicable when distributions are being made from funds that are established in these entities. Again, UAE has the same rules. So principally, if we see that we see that UAE is at par when we talk about Luxembourg, Singapore, and Hong Kong. Now, while talking about the other key consideration, we see that a lot of non-resident funds or investors would engage UAE-based fund managers to take care of their funds and wealth. And this could potentially trigger a situation where a permanent establishment is created. So what a permanent establishment means is that a non-resident has some form of presence in the UAE, which gives UAE the right to tax on any profits that are derived in the UAE. Now, to prevent any of the situation, the UAE CIT law provides for an investment manager exemption, wherein a non-resident fund or an investor that engages with a fund manager here could benefit from this exemption, such that the profits derived from that business is not taxed in the UAE. Now, there are a couple of conditions that are outlined for investment manager exemption. If these conditions are met, no PE would be triggered. Having said that, if for whatever reason the conditions are not met, that does not mean that a permanent establishment of the fund is being triggered. So even if the conditions are not met, if a fund or an investor has a PE, has to be evaluated separately. Now, talking about the conditions for availing this exemption, the fund manager should be providing investment management services as well as brokerage services. So this could be in the form of transacting in financial products. It could be for real estates. It could also be relating to foreign currency. In addition to this, fund placement activities are also covered. So if you look at the definition of fund management exemption, fund management services, that is included in the QFCP. The benefit that is provided for this section is much wider, because your brokerage services are also covered. The fund manager has to have a regulatory oversight in the UAE, so that is also important. The transaction should be carried out in an independent capacity. What this means is that the fund manager is not bound by the instructions of the fund or the investor. It performs its function in its own professional discretion. The transaction should be at ALP, and the manager should receive due compensation. So let's say if there's a fund manager that performs services for its related party, it has to be at ALP. However, when it's transacting with a third party, we presume that this condition has been met. Another way to look at this is, if a fund agrees to pay a certain fee to the fund manager, and the investors are also okay with the fee structure, then this condition is said to be met. And in addition to this, no representation for any other kind of income should be made by the fund manager. So as long as the representation is made only for fund management business, that's okay. But if it goes beyond the scope of fund management business, then this condition will not be met. Now, Thomas would be speaking about the compliance obligations.
All right. Looks like I'm getting a hang of this software. Thank you very much, Nishi. A lot of food for thought and a lot of very interesting comments there. As to compliance obligations, as most of you would probably already know, if you're in the UAE, throughout this year, any entity, depending on the issuance date of its trade license, should be registering for corporate income tax with the Federal Tax Authority. Most companies have done so, with the necessary complications sometimes when the legal structure is slightly more complex. Specifically for funds, though, there are specific steps to be taken. The first one being that the fund itself has to register with the FTA, the Federal Tax Authority, and obtain a tax registration number. Goes without saying, probably. And once registered, the QIF has to apply to the FTA to obtain a corporate income tax exemption. That application should specify the tax period for which the QIF intends to be recognized as an exempt person. The deadline for the application has already passed, however. Hopefully we'll be able to count on some leniency from the Federal Tax Authority as to the application. In addition to this, the QIF needs to file an annual declaration to the FTA to confirm that it continues to meet the exemption conditions. And additionally, it falls under the other obligations that normal taxpayers also have, such as the record keeping for 7 years to demonstrate the exempt status, and financial statements and other relevant compliance. Currently, there are no additional compliance obligations imposed on QIFs, for example, in regards to the income which they distribute. Currently, they are not required to report this additionally to the Federal Tax Authority, but I believe it'll probably take a couple of years before that actually will happen. Then talking about VAT for a bit, something that was perhaps a long time in the making is a change in the VAT regime applicable to fund management services. The very interesting thing is when VAT was introduced in 2018 in the UAE, while on the basis of the GCC VAT agreement, a lot of inspiration was drawn from the EU VAT directive. That was not the case for financial services. And the governments, not just in the UAE, but also in Saudi, they saw other regimes that were making a different type of or adopting a different type of approach towards financial services, essentially consisting of the following, is to say that all margin-based services are exempt and all fee-based services are taxed. You could probably see that from afar, creating issues for fund management services, because the practice would be, for example, in the European Union, but also in the UK, is to make fund management services VAT exempt. Right. And many fund managers in the UAE, unfortunately, have made the mistake to not apply VAT on fund management services when they started off, or to have mistakenly qualified certain types of fees as fund management services. So the UAE having come to the conclusion that from a VAT point of view, the UAE might be less competitive as compared to other jurisdictions, has now decided, as from the 15th of November, to exempt fund management services. The way that it is defined is that it refers to the services which are provided by a fund manager independently for consideration, to funds which are licensed by a competent authority in the States, and then this would include, but not be limited to, as you see on the side, the management of the fund's operations, the management of the investments for or on behalf of the funds, and monitoring and improvement of the fund's performance. What you don't see in here are performance fees, and the description is reasonably broad, which triggers a complication, right? For fund managers today, that would have considered their fund management services as subject to VAT, and fund management services is the only income that they derive. As from the 15th of November, they are no longer making taxable supplies, and therefore should deregister for VAT purposes because they only make exempt supplies. When making exempt supplies, it means that you have no input VAT recovery for input VAT, which relates to those exempt supplies, which means you lose it altogether if the only income that you derive is from fund management services. Now, there could be situations of other types of fees as well that a fund manager might earn. So far, it has not been clarified when it comes to other types of fees, whether that you would term those performance fees or carried interest, or subscription fees, or perhaps other fees for other types of services. That has not been defined so far. But I would be careful in making the scope too wide for fund management services, notably the exemption applicable to fund management services, because this would be something that the Federal Tax Authority would take an interest in. Now, if a fund manager has multiple types of fees which it earns, which are both VATable and exempt, there is no need at that point to deregister for VAT purposes, but there will be a need to go and apportion the input VAT deduction of the fund manager. So it's a reasonably complex situation with a bit of uncertainty, I would say, a bit of uncertainty also around how we deal with the transitional aspects of, for example, a quarterly fee, where now the VAT is no longer applicable as from the 15th of November. I think we've timed our presentation quite well. I'm going to be stopping sharing my screen, and we're going to be looking at a couple of the Q&A questions that are in the chats. And I can already reply to an easy one from Mohammed, which is whether the session will be recorded. Well, the session is being recorded, and it will be posted on our YouTube channel, which I encourage you to subscribe on so that you immediately get the alert when it is posted, which will be reasonably soon. And you can find all of our previous webinars as well on our YouTube channel, should this interest you. Nishi, is there a question that you would want to take here? You can use my microphone meanwhile.
So Ahmed has a question on difference between holding of shares and securities for investment purposes and the fund management services. Except in the latter, the funds are managed. So that there is a distinction between the two. Holding of shares is done as an investor. However, fund management services is a service that is being rendered. So both the activities are actually different. So they have to qualify under separate activities. Then there's another question by Nida. The question is, if the industry company has acquisition cost of more than 4 million, but less than 5% share in distributable profit, whether participation exemption can be fulfilled? No, that's unfortunately not. All the conditions are required to be met. The acquisition cost is associated with a 5% ownership interest, and the 5% share in distributable profit is a separate condition.
Cool. I'll take a couple as well. Irfan is asking, fund management services provided to foreign entities, whether the export of services will be subject to a zero rate of VAT. The tax advisor answer to this would be yes, but it depends, right? But in principle, yes, indeed, they would be zero rated. So despite the fact that the exemption applies, you're correct. If a UAE fund manager manages a foreign fund, then indeed the services will be zero rated. Luke is asking if we will be able to share the slides. I think I would have absolutely no issue in doing this with you, Luke. You're asking that it would be interesting to hear what you think will happen to foreign partnerships, given the criteria to be transparent seem difficult for managers to comply with. So I think here from there's a couple of things which are at play, and it's hard to reply to this in a couple of seconds, really. But we haven't talked much about local branches of foreign partnerships. There's indeed conditions associated with this. In a general sense, the condition would be that the head office partnership would be transparent and that the partners are taxed there. There is a certain amount of complication as to whether that means that the partners need to be taxed in the country of the head office. So I wouldn't say that that's necessarily something that has been clarified. Now, when it comes to UAE partnerships for investment purposes, as we said earlier, we need to look at um, the legal framework associated with it, because the UAE's starting position is that if an entity has legal personality, it is in scope and therefore opaque and non-transparent of corporate income tax. So we would expect that the number of limited partnerships that can benefit from the transparency as an unincorporated partnership in the UAE would be quite limited. And additionally, I would say, as Nishi was discussing, treaty relief for investment funds, there is obviously a complication with the application of double tax treaties when it comes to transparent entities. So I think in practice, we may see not so many transparent partnerships in the UAE. Do you want to answer another one, Nishi?
Yeah, so I see another question by Neera. He's asking how to determine the ownership interest on fund. Fund issues units, so how will it work in that scenario? That's actually a practical challenge, especially when it's an open-ended fund. And when you see that the units in the funds are changing on and off on a daily basis, this is something that there's no guidance actually provided on this.
Yeah, I think this may be an evolving matter as well. There's obviously records to be held by the fund as to who holds the units, and I think this is probably going to be something that we're going to see additional reporting required in the future towards the FTA. Prajakta is asking whether the VAT on fund management services would be 0% with retrospective effect. So it's effectively going to be VAT exempt as from the 15th of November, but it will not be with retroactive effect. Do you want to take another one, or do you want me to?
There's one question on the recent guidance that the IFC limited partnerships are considered as incorporated and hence fiscally opaque. As Thomas earlier mentioned, the tax consequence for the domestic partnerships are going to be based on the legal structure and the regulatory way in which they are structured. So even though other jurisdictions may consider limited partnerships as fiscally transparent, until as the free zone specifically state that they are considered as fiscally transparent, CIT law will treat it as opaque.
There's a question also from Yogesh, which I think is not really an investment fund question, but happy to reply to it. The question is whether a company registered in JAFSA and is giving a loan to related parties or unrelated parties outside of the UAE, if that interest income will qualify for 0%. Financing to related parties qualifies, but financing to unrelated parties would not qualify. So to the extent that the non-qualifying proportion would exceed the de minimis, the 5 million or the 5%, as Nishi said earlier, then that would disqualify the JAFSA entity for the QFZP status for a period of 5 years. Let's see if there's any other questions still that we would address right now. I think we unfortunately don't have the time to address all of them. But what I would suggest is if there's any further questions still that anybody would have, please feel free to drop us a note through info@ourfer.tax. It'll find its way here internally. I'd like to thank Nishi for the very interesting context and analysis in regards to UAE investment funds and the local context around this. I think this was a very interesting session, which we haven't seen on the market so far. It's a sector that we know very well, that we work a lot in. So we look forward to continuing that. And also, obviously, we will be on the lookout for further guidance from the FTA on a number of these, on a number of the aspects which are still to be determined and which will still be in evolution. Wishing you all a very excellent rest of your day, and be in touch soon. Thank you very much.